Hello and welcome to our video for the extra problem, which is in Chapter 7, Problem 7-9. Let's first start out by reading the question. And when you're reading the question, I really want you to start identifying particular items and knowing where they fit within the different steps. On January 1st, year 1, Porter Inc. purchased 85% of the voting shares of Sloan Limited for $3,026,000 in cash. On this date, Sloan had common shares outstanding of the amount of $2.2 million and retained earnings of $1.1 million. The identifiable assets and liabilities of Sloan had fair value that were equal to the carrying amount except for the following. So right here, I would be expecting them to almost give me the items that will be rolling into my acquisition differential. Plant and equipment, net, so the reason why it's net is really important is because now we don't have to back out any accumulative depreciation. Had a fair value of $200,000 greater than its carrying amount, and remaining useful life on January 1, year 1, was 20 years with no anticipated salvage value. Okay, so now we know really over what period of time we need to amortize this $200,000. If accounts receivable had a fair value of $75,000 less than the carrying amount, so we need to make sure since it was less, we'll need to add that as a negative. Long-term liabilities had a fair value of $52,680 less than the carrying amount, so now remember that liabilities are typically shown as a negative in our amortization acquisition differential schedule, but as in this case it's actually less than the carrying amount, it will show as a positive figure. These liabilities were issued at par and maturing on December 31st, year 10, so really we're just going to amortize over 10 years. Now a whole lot of additional information. Do not get overwhelmed. Take it bullet point by bullet point, and if it may be relevant, perfect, pull it over. If you're not sure, just star it and leave it to the side. Between January 1st, year 1 and December 31st, year 3, Sloan earned $345,000 and paid dividends of $115,000. So at this point, you know what, looking around, okay, it's not that relevant to the information that we need within the first few steps. We'll leave it for later. Goodwill impairment tests yielded a loss of as follows: year 1, $30,300, year 2, $6,075, and year 4, our current year, which is $12,125. That's going to be important because we want to include that on our schedule in step 2. On January 1st, year 2, Sloan sold a patent to Porter for $160,000. On this date, the patent had a carrying amount on the books of Sloan of $185,000 and the remaining useful life of 5 years. So in this case, ding, 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 you know what? We have something different here. We have a depreciable asset being sold between the two parties. Now we want to remember who is Sloan, who is Porter. So if Sloan is selling a patent to Porter, and Porter is considered the parent, coincidentally we're dealing with an S and a P, it will be an S to P transaction, which is upstream. You can see the difference between the two values there is going to be $25,000, and it tells us over 5 years. So just off the quick math in our heads, we'll be able to figure out we're playing with $5,000 per year in amortization. This is going to be really applicable in our step 3 and figuring out our intercompany profits or losses. On September 1st, year 3, Porter sold land to Sloan for $93,000. The land had a carrying amount on the books of Porter for $72,000. Sloan still owned this land on December 31st, year 4. So since Porter is selling down to Sloan, it will be considered a downstream transaction. And we can also see the difference, just eyeballing it, is going to be $21,000. So that's going to be really important also for our step 3 calculations. On year 4, December 31st, they give us the income statements and then adds a note that Sloan uses cost method. So good to know. Porter and Sloan paid dividends of $125 and $98 respectively in year 4. We don't really care too much about what Porter's doing, but we really do want to focus in on Sloan, and the fact that they paid a $98,000 in dividends means that Porter did receive a number of it. We'll need to do the calculation and back out those dividends for consolidation. Sloan issued no new common shares, good to know. And then they give us the balance sheets for the two companies. Just eyeballing it, it doesn't really give us a ton of information. Nothing like an intercompany advances listed. Those are the ones we'd really want to look out for. Then we have 3 more points. During year 4, Porter's merchandise sales to Sloan were $115,000. Interesting. Okay, now we have an intercompany transaction. We're going to need to capture that full $150 and back it out of sales and COGS. The unrealized profits in Sloan's inventory on January 1st and December 31st, year 4, were 14 and 10. Okay, that is going to be very important also for that step 3. And then it gives us at December 31st, year 4, Sloan still owed Porter $5,000 for merchandise purchases. Okay, so here we actually have another intercompany transaction. This one is going to be different than the ones we've seen so far, because this is going to be between AR and AP. It continues on telling us Sloan's merchandise sales to Porter. Okay, so they also had some upstream transactions. Were $55,000, and unrealized profits in Porter's inventory on January 1st and December 31st, year 4, were $1,500 and $2,500 respectively. So once again, we're going to be capturing our beginning and ending inventory. Then at December 31st, year 4, Porter owed Sloan $2,000 for merchandise purchases. Okay, so that will be in addition to that $5,000 listed above. We need to be capturing both of these amounts. And then lastly, we absolutely need to know the interest tax rate, and in this case it's 40%, and then straight line for PP&E and long-term liabilities. The required for this question, and remember that we're only doing A, is to compute the balances that would appear in the consolidated balance sheet of Porter and Sloan at December 31st, year 4, for the following: the patent, the goodwill, retained earnings, non-controlling interest, and lastly, long-term liabilities. So now we actually are ready to start crunching some numbers. You can see I've had everything sort of laid out on the screen just for efficiency purposes, but let's start calculating this. First things first, we have our 85% investment in Sloan. We'll want to jot that down, of that $3.026 million. Now the implied investment, we'll take the amount above and divide it by 0.85. So it comes out to $3.56 million. Now, the carrying amounts of Sloan's net assets, we were provided these figures in the very start of the question, so let's enter them in. And I like to have my commas in there and no decimals. So of course that means our shareholder equity, you can sum it, actually let's just change it around, we'll just do all formula driven. I'm going to do that and that one. Our acquisition differential is going to be the difference between that 3.5 and the 3.3 and change, so we have $260,000. Now we are ready to start recording some of our fair value increments. We were told in the question it was $200,000 for our plant and equipment. Our AR, remember, was actually less than the carrying amount. And so was our long-term liabilities. And considering liabilities are typically in a negative, we want to make sure it is positive. And then our goodwill balance. So we're going to do that. Minus that one, and that one, and that one. Adding the right formula would be helpful. There we are, so it's 82,320. Let's continue on and complete our step 2, which is right in here, our amortization schedule. So for PP&E, we have 200,000, and remember that they told us it was going to be over 20 years, no salvage value, so we can easily calculate that as 10,000 a year. Since we're dealing with 3 years here, it'll be $30,000, 10,000 here, and our balance is going to be that minus these two transactions. AR, we start off as the negative 75. Remember, AR is very similar to inventory in that it clears within the 1 year. Will be 0. Next, our long-term liabilities, 52,680. Now we were told that this is over a 10-year period, so if you want to, it might be easier for you just to do sort of a calculation like that, over 10 years, and then times it by the 3 that have already lapsed. You can do that, divided by 10. And our goodwill. So our goodwill will start off with what we calculated up here. We were told that there is year 1 and year 2, there is already impairments. So it will be a combination of the 30, where did it go? Where is my impairment? I just saw it. There we are, 3,300 plus the 6,075. And then in year 4, it's 12,125. At this point, we are ready to calculate our total. So we'll just do a sum of this down. Looks good, because it should be very much aligned to our acquisition differential. Let's carry that formula across. Now remember that the years 1 through 3 will go and impact our subs opening retained earnings. Year 4, as it's current, it will go into the subs adjusted net income, and year 4 balance is going to be impacting the subs adjusted net assets. Let's continue on, and we won't be able to get through all of step 3 in this recording. I'll hop into the next one, but just a few items to point out to start off our step 3. So we have our intercompany dividend revenue. That one is going to be a calculation of the 98,000 in dividends that Sloan paid times our 85%. So 83,300. Our intercompany transactions, like I mentioned before, is a combination of the 5,000 plus that 2,000 for the merchandise that has not been paid for each of the respective companies, so a total of 7. The intercompany sales also need to be backed out, so there is 150 and also that 55,000. A total of 205. Now I've also jotted down the different accounts that will be impacted here. You're going to have the 83,300 impact both your parents' adjusted net income and dividend revenue. The intercompany transactions are going to be between AR and AP. And then lastly, you're going to have the intercompany sales, offset sales, and COGS. Now at this point, I'm going to conclude our first of a few videos for problem 7-9.